Hey friends, in this video I'll be discussing and giving a step-by-step guide on how to day trade. So you already know how it goes. Run my intro. Hey friends and new traders, welcome back to the channel. If you're new here, my name is Matt and I teach day traders just like you how to become profitable by teaching different tips and strategies. With that being said, let's get into this one. All right, so obviously this is a step-by-step guide on how you can start day trading after studying this. So I'm gonna start off first with currency pairs. So I'm not gonna go into like the whole what a pip is and all that, but I will give you like what a currency pair is, so at least you have that knowledge to begin with. So in a quick Google search, it'll tell you the base currency represents how much the quote currency is needed for you to get 1 unit of the base currency. For example, if you're looking for the CAD USD currency pair, the Canadian dollar would be the currency and would be the base currency, and the US dollar would be the quote currency. So for this video, I'm gonna be working with the the gold versus the dollar because that's my favorite pair to trade. So just like that example I just gave you from Google, you see XAU, which is gold, will be the base currency, and USD will be the quote currency. So pretty much what that means is when gold is going up, the dollar will be going down, and when the dollar is going up, gold will be going down. All right, so that's pairs, that's currency pairs. The next thing you need to know, what are candlesticks? So what you see right here on my screen is, this is gold right here. So gold is currently going up, it's the blue, and when it's going down, that's when the dollar should be going up. And when the gold is going down, it's represented as red candles. Those are the candle colors I chose. To change that, you could easily click on your trading view, and trading view for me personally is it's like the gold standard of for trading. If you want to trade, it's just a clean layout for you to mark up your charts and do your technical analysis, things like that. So that's why I use trading view. So yeah, so you could right click on the screen and go to settings, and then you could easily change your candlestick colors. So this will be representing it being bullish going up, and this will represent it bearish being red going down. So you could easily change this. So right now I'll put this as, let's say, that's kind of goldish, and then so that's going up, and then when gold's going down, I could change this to the black. So there you go. All right, so let's get more into Japanese candlesticks. So right now, let's talk about this one right here. So right here, the very base of the candlestick, this is where it opened at, right here. This level right here. And if you look at the top of the screen, you can also see the levels right here for the candlestick. So right here would be the opening. Look at this price right here as I move the mouse at the bottom of the opening of the candlestick. So the O represents the opening of the candlestick. So right here we have the opening, and look at that. Look at on the screen. It says 19949, 1997.49. That is the opening. And if you look to the right side of the screen as well, I could just mark it off so you guys could see it. You have it right here as well. So that would be the opening price right there. So candlesticks, they open, and then you have some type of retracement. That is what you see right here, this line right here underneath the candlesticks. And this is the body of the candlestick. This whole thing you see is the body of the candlestick, and above it and below the body, that's what we call the wick of the candle. So this right here considered the open, and then we have a retracement, which is the wick. And when it goes like down like this, we consider this the low of the day. So the low of the day would have been 1980.56, and you could also check it. You could also see that we have the low of the day right here represented up here with the L and these numbers right here. So look at it and you can see that it's 198082. This is not going to be the exact number as if I put it on here and then check it right here, because obviously I'm just putting it like as I see it. But if you want to adjust it, because at some point in this video I'm going to go over actual key levels, so this is how I would adjust it. I will go to coordinates and then I will enter the number right here to have the exact number as I see up top here, to have the exact key level. So I'll get into that soon, so just give me a second, bear with me. Okay, so that's considered the low, and then the candle moves up for the day. So we have the opening, we have the retracement, which makes the low of the day. It goes all the way up. Consider this the high of the day. And you can see it right here with the H representing the high of the day, which was 2070.35. And then we have the close when it retraces back down for the day to close off for the day. All right, so, and that would be this number right here represented by the C, which is the close. And as I put it right here, you have 2048.55. So once again, you have the opening price right here, the retracement lower, which makes the low of the day, and then it makes the high of the day, and then retraces for the close of the day. So in a nutshell, that is a Japanese candlestick and how it works. Now, for some of you guys, you might be in your trading journey where you're learning Japanese candlesticks, or you're trying to remember Japanese candlesticks and you think you need to know all these Japanese candlesticks. So let's check this out real quick. Japanese candlesticks. Actually, this is actually a book that I actually read as well. This Japanese candlestick charting techniques. I actually read this book. It's a pretty good book, but after a while, I just realized that I didn't need to know all these Japanese candlesticks. I only really need to know one candlestick. So I'll get into that in a second. But if you really want to know, like, just for your own personal knowledge, you could go into Google and just simply put Japanese candlesticks, and you could get all the different patterns here, like the hammer, the doji, bullish engulfing, tweezer tops. But for me personally, I do not use all those candlesticks. I just need to know one candlestick, which helps me a lot in my trading. So, and I actually already have a video on this YouTube channel. So if you want to go check that out, the only candlestick pattern you need to know, which is the return candle. All right, so prime example, you could consider this a return candle right here. All right. So we got pairs. What is a pair with our candlestick? So now let's get into key levels. So we need key levels to know where the market is headed to and where we could trade from. That's the importance of key levels, and it's always important to mark up your charts with these key levels. So for me, the key levels that I'll use are like recent highs, recent lows, the return candle, and forever paid gaps. So I'll start marking off the charts with these key levels, and you can consider this as well as a top-down analysis because we're going to start from the top and work our way down to the 4 hour. So those levels that I just talked about, that recent high, recent lows, return candles, and forever paid gaps are the only key levels I will use to know where the market is going or where the market could potentially head to. So we'll start with the monthly level. So over here in TradingView, you got all these line tools that you could use to draw lines with. I'm going to use the horizontal ray. So these are the three that I will use, like the horizontal line, the horizontal ray, and the trend line. So for now, I'm just going to use the horizontal ray right now. Okay. So this will be the last high on the monthly chart. And say this is the last low on the monthly chart. All right, so we have the high and the low, as well as I was talking about just having the exact level. So going up to the top of the screen right here, we can see what the high was 207035. 2070.35. Yeah, so that's the absolute exact level for the high. Then we have the low. You want to mark off the absolute exact level for the low, which is 1786.50. 86.50. So we got the lows, we got the highs. That's the monthly chart. All right, so as far as the key levels that I mentioned, the highs, the lows, forever paid gaps, and return candles, I don't see a forever paid gap, but I do see a return candle. So a return candle is pretty much the last up candle before you had like a big drop in the market or an impulsive move. And at some point, the market is going to want to return to that return candle. So we can simply mark that off. And we put it at the open of the candle. So the open will be 190866. And since this is just a quick step-by-step guide, I will say that I do round it to the nearest zero or the nearest 5. So saying this is like 207035, I will mark it down to the nearest point. So it'll be 2070.30. not 3.5. If I was to, so say you're going towards a point, you want to bring it down, you want to round it down, and if you're going towards a point, you want to round it up to the nearest 0 or 5 point. So we have the highs, the lows, and monthly levels. All right. So now let's move our way down to the weekly. For the most part, a lot of these levels will be the same, but you're just pretty much getting better execution with these levels. You're pretty much getting better execution with these levels as you go down each time frame. So real quick, let me go over time frames as well. So M stands for monthly candles, W weekly, and you can see it underneath as you put your mouse on it, it'll tell you. So this W will be weekly, daily, 4 hour, 2 hour, 1 hour, 30 minutes, 15 minutes, 5 minutes, 3 minutes, and 1 minute. Just to let you guys know what these time frames mean. So like a monthly candle will be like just one candle. You already know what a month is, how many days is in a month. The weekly, how many days in a week, pretty much, in the days. Same thing, just going down. All right, so weekly, I like to use this highlighter tool, this box tool, rectangle tool, to mark my my forever paid gaps. So forever paid gaps is when you see the market push down and then you don't really see like it's imbalanced. The market is pretty much imbalanced. So we have it being sold off, but we don't have no buying going on, if that makes sense. So we have it going down, down. We had a little bit of retracement with this up candle, but it didn't close in this level right here. So when you see like a level right here where you just have down and we have a lot of down movement and no return, or it doesn't fill this gap right here, then you can mark it off because potentially this is a level, a major level, and the market will want to return to it. All right. So the market potentially will want to return to this level. And as you can see, it is confluence as well with the monthly return candle level. So 1 second, let me go back to the monthly as well. One thing I like to do as well is write down what these levels are. So I'll put like monthly high, monthly low, monthly return candle, and then now we're going to the weekly, which I already started. Go weekly forever paid gap, so FPG, could put that in the center for the text, center it. All right, so we got that. And then what else do we have for the weekly? We got this weekly return candle right here as well. So for like weekly dailies, I like to make like, if I have an up candle, two up candle consecutively to one another, I consider this one one candle. So that'll be one level. So instead of this one candle, it's together. So I'll put it as one whole full return candle. So that would be a level right there in itself. So since we have the weekly forever paid gap, I won't put it there because I just want to keep my charts nice and clean. We do have that level there. So I'll either like take a mental note of it or just write it down somewhere so I don't remember, or I'm constantly looking at the chart so I'll obviously see it. But for you, you might want to write it down or um, layer it down on this as well. But I'm not going to do that right now. And then we have this weekly high right here. I'm going to change the color so you know I know it's weekly. Go purple for weekly. So I got a weekly high right here. And then I think that's it for weekly key levels. So let me mark this down. Weekly high. Change the text purple. All right, so we got this weekly high, weekly forever paid gap. And obviously this will be a weekly low, but we already have it down as the monthly low. As I said, a lot of these levels will be one and the same. And we do also have, this is something that I like to take like mental notes of, or I'll write it down in my notes. Something like this, like a certain level. So this level right here, this is where market structure was broken right here. As you can see, it was going up for a bit and then consolidation for the past weeks. And then we had a break of structure. So currently it looks like we're in a downtrend for the market. So that's something you always want to keep note of as well. Like if recent highs and recent lows have been broken. So that, and seeing that something like this, like a recent low has been recently broken, you could expect some retracement definitely back up to this level because it is a recent low. So I'll actually mark this one off. See how this level right here, so weekly low. So that's where the market could run up to. So weekly low. All right. Now to the daily. So daily, we have the return candle right here. And for return candles, it could be the body, it could also be the wick. So right here we have the wick. So I'm gonna actually explain the charts as I see it right now and the potential movement it's gonna have for the upcoming days or weeks. So right now we're on the daily return candle. That blue line. So look at this. We had break of structure, and then it came back and returned to the return candle. Perfect support, right? You see that? Perfect support. So what do we have right here? And where's the market sitting at right here? It's sitting again at another return candle. This high was somewhat broken. So potentially we could see the market either come down a little bit more, maybe run these lows, these daily lows. I'm gonna show you guys something real quick. So daily lows. Cause you see how the candle didn't actually like come to this full body. It's just hanging down right here. The mark, and we got a daily gap as well right here. I'm not gonna mark it down. You could clearly see it. The market did fill that gap a bit, but it could potentially still come down some more. Take out these lows, because that's what the market likes to do. It likes to like trick traders into thinking it's gonna go higher, because you know it bounced off support, it went higher, but look, it took out these highs. So one thing you got to know about the market is it's always going to seek liquidity. So liquidity is like buy stops. So people have buy stops right here. So when they place buy stops right here, the market trades through it, it'll trigger their trade, right? Or they'll put their stop right there. Say they're selling it right here. They'll put their stop, or they're already in the trade. They'll move their stops down here. So we got buy stops and sell stops. So buy stops is being triggered once it goes up. They're expecting the market to move much more higher, right? And then the market will like just take out those buyers by bringing the market down, and they're already lost. Or if you have your stops right here, if you moved your stops, say you're already in the trade and you move your stops down to here, the market will trick you, take out your stops, and then run it down lower, potentially filling this gap right here, because the market it didn't completely fill, so it might come down to the actual candle. So we can actually mark down this candle as well, which I usually do as well. So daily return candle. So, and then we got, for people that's going long, so say you got in right here and the market goes up, or you enter right here, you put your stops right here. Obviously you're going to put your stop at the lowest low. That's what you've been taught, right? At the last low, that's what you've been taught. So the market will come back down, take out your low, and then potentially keep going higher, seeking liquidity each time. So look how clear the chart looks right now. Look at these levels. So that's just the monthly, weekly, daily. If you want, you could go into 4 hours and look for the exact same key levels. I'm going to continue marking up this chart. So we got the down candle. Once again, like I said, it could be the wick or it could be the body. You could put it at both. The last up close candle before the down move. So put daily return candle. See my chart's kind of getting a lot of levels now, so I'm gonna try to keep it clean as possible. I just take a lot of mental notes, or I write it down, knowing the levels where it's at. So you can see that this will be part of a daily return candle, this wick right here, which the market did bounce off of one time and then came back up. So I want to let you guys on a little secret. as to like where the market could potentially go right now. So just by looking at the daily chart. So we got this down close candle, right here. Market breaks through, breaks above, and then takes out these highs, and it comes back down, right? If the market was to potentially, like, say about 50% of this candle right here, close below 50% of this candle. So the 50% mark is like right here. So you could just use the Fibonacci and have it marked up. I'll give you the Fibonacci levels at the end, or you can watch my Fibonacci video on how to use the Fibonacci, get a clearer understanding. I go into great details on how to use it. So as of right now, the market didn't go below this down candle, this daily down candle. So as of right now, we're still pretty much bullish for the, yeah, we're pretty much bullish right now. So all right, so daily 4-hour, let me check if I got all the daily levels. So we got the daily low. I'll actually remove this one because you already seen that that's what it did, but got this low right here. Got this return candle. Do we have any gaps? We have this gap right here, so I'll mark it off. So that's a fair paid gap. Confluence with the daily return candle, so could make this blue as well. So any blocks like this, any rectangle shapes like this, I know that there's a space that needs to be filled eventually at some point. So for right now, these are the major key levels you want to look for the market to be heading. So in the long term, we got the monthly. The short term, we got the weekly. And in the daily, we got obviously the daily. That's how you could break down the market. So all right, so let's get to market structure and how to know which direction you want to be trading in. So for you new traders, you could obviously use, the only indicator that I really use is the moving average. And the moving averages, they're like moving support and resistance. It allows you to know exactly when these levels cross. I'm going to show you in a second. When these levels cross, you know that it's headed in a certain direction. So indicators, and then we got one at 9. It could leave it at 9. Style, I'll just put this one as, since we're using the gold chart, put this as gold. So that's the close moving average. This is the other moving average. That's going to be on the outside. We'll put this as black. And I didn't change the input. You put the second moving average as 18. All right, so for day trading now, we're getting into the meat of this, the real pause, the real meat of this this step by step to know which level it's going to be potentially trading to. So for the moving averages, for day trading, you want to focus on the daily and the 4-hour moving averages. So You got the black line, which is the 9 moving average, or you can put it to 8. Doesn't really matter, not big of a difference. And you got the 18 moving average, which is on the outside. All right, so the daily, the 4 hour. So right now, we got the daily. We're in a downtrend, correct? The gold is on the inside. We're on a downtrend, and then it crosses over. So that will potentially let you know that, hey, right now, since the gold just crossed over the black moving average, the the trend is changing and it's going up for now, because there is always a bigger picture, the monthly and the weekly. But for now, for day trading, you want to focus on the daily and the 4 hour, like I said. So these are the daily moving averages. It's on the upside. As you can see, the gold is on the inside. So that means it's an uptrend on the daily. The 4 hour, the same thing, right? The exact same thing. The 4 hour just previously crossed over. And like I said, it swept this high right here, right? But remember, we have this daily return candle. It didn't completely go back to it. So this is that gap that we're talking about. It filled the gap, but it didn't completely fill the gap. Now, when trading, you always want to enter. It's important. You always want to enter on the retracement. So when the market, say the market is going up, you want to enter when the market is coming back down. So when as it comes back down, that's when you enter, and it goes back up. Okay, and vice versa. When the market is in a downtrend, you wait for the retracement going up, and then wait for the market to come back down, to go down. So once again, I'll say it again. In an uptrend, you want to wait for the market to retrace back down to enter. In a downtrend, you want to wait for the market to retrace back up to enter. And then all you're simply doing is where you'll take profit at the return candle. So on the 4 hour, you take profit on. So we did the daily, right? So now we're talking about the 4 hour. So on the 4 hour, you take profit at 4 hour return candles and the highs. So right here, potentially, this is where I'll take a partial profit. Right here at this return candle when I enter. Because right here, look, the market retraced back down to this 4 hour perfect. This 4 hour, there's also a forever paid gap. So that should let you know. This forever paid gap. Mind you, we're on a 4 hour now. So forever paid gap, if came back, filled it, which is perfect. And we have the return candle, down return candle on the 4 hour. So when you see that confluence together, that gives you extra confidence to enter the trade. Now, the reason being I wouldn't enter this trade because this was during a news release week, fundamental news release weeks, what happens every first of the month. So during those weeks, you want to avoid the market because it could be crazy. Definitely for new traders, at least if you're like a little bit advanced, you could potentially trade it if you see something during certain times. I'll get into that in a second. All right, so we have this up movement, comes back down. I think the market is going higher, potentially to close to this return candle where I'll take my second profit, and then if I hold it, I go hold it to this weekly low. So these are the levels that you'll be taking profit at. So you got the 4-hour level, you got the daily level, and then you got the weekly level. And if it continues and you really want to hold it, you can hold it all the way to this monthly level. So that is a top-down analysis in a nutshell. Now let's talk about confluences. So confluences is like different elements of a trade that'll help you be confident in your trade. Once again, I do have a video, or I should be putting out a video on confluences if I haven't put that out yet. I don't know which one of these are coming out first, but hopefully I do put that one out. All right, so Fibonacci from the low to the high. All right, and it does confluence, as you can see, with this gap right here and the down candle. So potentially you would want to enter. So confluences, mark up this tool right here. So we got consolidation, right? Got the high, low, high, low, and then these highs are broken. So you know for sure if the moving average doesn't let you know, which it already shows you that we're in an uptrend. This break of market structure right here, that is letting you know that we're going higher. So the market does make higher highs and lower lows. As for market structure, you could do a quick Google search on higher highs and lower lows. It'll let you know exactly and show you exactly how it looks. I'm just going through this real quick so you guys could like get started with your trading. Really basic. So you're still breaking market structure. So that's confluence number 1. Retracement, confluence number 2. Into the return candle, as well as the gap, forever paid gap, confluence number 3. If I was trading on this day, 9 o'clock. So you want to enter your trades around 2 and 4 o'clock, between 2 and 4 o'clock for the London session, and write it down, between 2 and 4 o'clock for the London session, and for the New York session you want to enter between 8:30 and 11:30 for the New York session. 11:30 is kind of pushing it, but I'll say 11:30. You could go 11:30. So we got break of structure, confluence number 1, confluence number 2, the retracement, confluence number 3, the gap, it's in the gap, confluence number 4, return candle, confluence number 5, below the 50 mark on the Fibonacci. So that is a recipe for the market to move higher. And as well, another confluence, we got the moving averages letting us know that, hey, we're in an uptrend right now. So all you need for a directional bias is the daily and the 4-hour moving averages to be going in the same direction. That is the gold being crossing over the black to the upside on both daily and 4-hour. So potentially the next move will be, like I said, to this level. You'll take partials right here. Our next profit level will be right here. And then potentially when you see it break this high, you look, if it doesn't already come to this level, which it might or might not, just go straight to this level. You want to see some type of retracement coming back down to this high. And we could go to the daily level as well to see what that high is, to make it much more clear. Which will be like, so on the daily level, this would be like the last highs. So this would be like support and resistance. Let me give you a quick support and resistance. So support and resistance. So you got that pretty much as resistance, which is like a ceiling that you can see hit the ceiling, but it did come back to, like, if you break down the charts on a 4 hour, you could see the actual level that those wicks are hitting. So it's not just hitting any random level. It's so on the 4 hour, this is probably like feeling like a forever pay gap or hitting a return candle. And if you don't believe me, I could actually show you right now. just to let you guys see it for yourself. So I'll mark this off. Mark off this level so you can see where this candle actually went. Four hour. See? The 4 hour return candles. So it doesn't hit random levels. So told you guys. Like, so just study your charts, man. Like, break it down like how you just see me break it down, and look how the market just bounces off these levels, and just use the moving average as your directional bias, and just wait for those entry points. Just be patient and wait for those entry points. And that's pretty much how you break down the charts and how you trade technical analysis. So I hope that was really informative for you guys. Please like, share, comment, subscribe to the channel. And if there's any more videos that you guys want to see on this channel right here, please leave a comment below. Or if you just want to say what's up, or if you like the content so far, just leave a comment below. Hit them thumbs up so we could grow this channel, this community. I appreciate each and every one of you guys. So thank you. Have a wonderful day. I am out. Peace.